January 24th, 2026. This is playing while you swipe past charts you don't understand, watching numbers move on screens that feel like entertainment, but something just broke. Silver crossed $103 in New York this morning. In Shanghai, it hit $115. That's not a price gap. That's a fracture line. Most people missed this. They saw the number. They didn't see what's underneath it. In September 2008, Lehman's stock was still trading. The price looked stable. The plumbing had already ceased. In August 1971, gold was still $35 an ounce. Fixed, calm, official. 3 weeks later, Nixon closed the window, and the entire monetary architecture collapsed overnight. This is how it always starts. Stability on the surface, rigidity underneath, loss of flexibility where no one's looking. Stop scrolling for a second. If you only listen to one part of this video, make it this. The danger was never in the price. It was underneath it. If this walk through financial history sharpens how you see risk, liking the video quietly tells the system this work matters. Now let's go back to where this structure was built. Picture London, 1897. The largest empire in human history is running on a single metal, gold. Every currency, every bond, every trade settlement between nations, all of it convertible into a fixed weight of gold at a fixed rate. It worked because everyone believed it would work. And it worked because the system had slack. Banks held reserves. Governments held reserves. There was room to absorb shocks, but by 1914 something had changed. The system hadn't collapsed. It had tightened. The financial plumbing that moved gold between nations, the clearing mechanisms, the settlement windows, the reserve buffers, all of it had become more efficient, more interconnected, more optimized. And optimization in complex systems is just another word for fragility. When World War I began, the gold standard didn't break because of chaos. It broke because there was no room left to maneuver. Central banks couldn't settle. Currencies couldn't convert. The system had become so rigid that a single shock propagated everywhere at once. The gold standard survived the war, but it never recovered its flexibility. By 1971, it was over. So what replaced it? Not gold, paper. Fiat currency backed by nothing except institutional credibility and military power. And for 50 years, that system worked. Not because it was stable, but because it was flexible. Central banks could print, governments could borrow, markets could absorb shocks by devaluing currencies instead of collapsing trade. But flexibility has a cost, and that cost is dilution. Every time the system absorbed a shock, the 2000 dot-com crash, the 2008 financial crisis, the 2020 pandemic, central banks responded the same way. They printed. The Federal Reserve expanded its balance sheet from $800 billion in 2007 to over $9 trillion by 2022. The European Central Bank followed. The Bank of Japan had been doing it for decades, and for a long time the consequences seemed manageable. Inflation stayed low. Markets stayed liquid. Asset prices rose. But here's what changed quietly in the background, while everyone watched stock indices climb. The derivative structure underneath global markets became unimaginably large. Silver futures on COMEX, the primary exchange where institutional players hedge, speculate, and manage exposure, began trading at volumes that dwarfed the actual physical metal available for delivery. In 2010, total open interest in COMEX silver futures averaged around 120,000 contracts. By 2024, that number had ballooned to over 180,000 contracts, each contract representing 5,000 ounces. Do the math with me. 180,000 contracts. 5,000 ounces per contract. That's 900 million ounces of silver obligations on a single exchange. Global annual silver mine production, roughly 830 million ounces. The entire COMEX had become a paper market so large that if even a small percentage of contracts demanded physical delivery, the system couldn't settle. And most participants knew this. They assumed no one would ever actually demand delivery, because futures markets aren't designed for delivery. They're designed for price discovery and risk transfer. The system worked as long as everyone played the same game. But what happens when someone stops playing? Between 2020 and 2023, something shifted. Physical silver demand exploded. Industrial use, solar panels, electric vehicles, electronics, surged as global decarbonization accelerated. Investment demand followed. Retail buyers poured into silver bullion and coins. Sovereign wealth funds quietly began accumulating. And then China entered the market. Not as a participant, as a buyer of last resort. The Shanghai Gold Exchange and Shanghai Futures Exchange, China's primary precious metals markets, began showing price premiums that made no sense under normal arbitrage conditions. In efficient markets, if silver trades at $30 in New York and $32 in Shanghai, arbitrageurs should buy in New York, ship to Shanghai, and pocket the difference. That pressure equalizes prices. But by late 2025, the premium wasn't $2. It was $10, then $15. By January 2026, it hit $20. Shanghai silver futures were trading at RMB $25,600 per kilogram. At an exchange rate of 6.96 yuan per dollar, that's $115 per ounce. New York spot, $95. Why wasn't arbitrage closing the gap? Because arbitrage requires physical metal, and there wasn't enough to move. COMEX inventories, the registered silver available for delivery, had been declining for years. In 2020, COMEX held roughly 350 million ounces of silver in registered vaults. By January 2026, that number had fallen below 230 million ounces. Meanwhile, short interest, the number of contracts held by institutions betting silver prices would fall, remained enormous. JPMorgan Chase alone was estimated to hold short positions, representing over 300 million ounces of silver exposure. Other major banks followed similar strategies. Why? Because for decades, shorting silver had been profitable. Prices were range-bound, volatility was manageable. And the assumption was always the same: physical demand would never exceed paper supply. But assumptions don't care about being reasonable, they care about being correct. And this one wasn't. The first crack appeared in November 2025. It wasn't dramatic. A single Shanghai metals trader attempted to take delivery on a modest futures position, roughly 50,000 ounces. The delivery was delayed, then rescheduled, then settled in cash at a premium. No one outside the clearing system noticed, but the people inside noticed, because cash settlement isn't supposed to happen unless both parties agree. And this wasn't an agreement, it was a failure to deliver. By December, the whispers were louder. COMEX had begun offering cash incentives to contract holders willing to settle without taking physical delivery. Premiums of 3%, then 5%, then 8%. Why would an exchange pay you not to take delivery if the metal was available? It wouldn't, and it wasn't. Now, pay attention to this part. In early January 2026, a mid-sized hedge fund in Hong Kong decided to test the system. They bought 10,000 COMEX silver contracts, 50 million ounces, and they demanded delivery. COMEX didn't default, they settled. But the settlement took 3 weeks instead of 3 days. And the metal came from registered inventory, the shrinking pool of silver actually available for immediate delivery, dropping COMEX's registered reserves by another 50 million ounces overnight. The numbers stopped making sense. If registered inventory was below 230 million ounces, and short interest remained above 900 million ounces, the system was running on a ratio of roughly 4-to-1 paper claims per ounce of physical metal. In a liquid functioning market, that's fine. In a market where participants start demanding delivery, that's catastrophic. And the data suggested someone was demanding delivery. By mid-January, the Shanghai premium had widened to $18 per ounce, then $22. Chinese buyers weren't speculating. They were draining the system. January 22nd, 2026, silver closed in New York at $96.50. In Shanghai, the equivalent price hit $112. The arbitrage gap was now $15.50 per ounce. But here's what made that number dangerous. Arbitrage gaps don't persist unless something is broken. Either, well, 1, physical metal can't move fast enough to close the gap, or 2, the people holding short positions can't deliver what they've sold. Both were true. Shipping physical silver from New York to Shanghai takes weeks, and COMEX vaults no longer had enough registered inventory to cover even 10% of outstanding short positions if delivery requests spiked. The system had become a structural short squeeze waiting for ignition, and the ignition came from an unexpected place. Not a hedge fund, not a sovereign wealth fund, a tariff. On January 23rd, the U.S. announced an expanded tariff framework targeting strategic metal imports, including silver, as part of broader trade restrictions aimed at limiting Chinese access to critical materials. The tariff was 15%. That number is important, because a 15% tariff on a $96 silver price is $14.40. Suddenly, the Shanghai premium wasn't a premium. It was parity adjusted for the new cost structure. Chinese buyers, anticipating restricted future access, accelerated purchases. By the morning of January 24th, today, silver opened in New York at $97. Within hours, it hit $103. In Shanghai, futures spiked to RMB $25,700 per kilogram, $115 per ounce. The gap widened again. But this time, something else happened. Major institutional shorts. The banks, holding hundreds of millions of ounces in short exposure, began covering, not because they wanted to, because their risk models forced them to. When you're short silver at $80, a move to $90 is manageable. A move to $100 is painful. A move to $103 with a $20 arbitrage gap to Shanghai and collapsing COMEX inventory triggers automatic position liquidation. And liquidation means buying, which pushes prices higher, which triggers more liquidation. This is the anatomy of a squeeze, not speculation. Structure. So what happens next? If the shorts keep covering, prices keep rising. If prices keep rising, more delivery requests hit COMEX. If COMEX can't deliver, the exchange either defaults or moves to cash settlement across the board. But cash settlement destroys the integrity of the futures market, because a futures contract is a legal obligation to deliver a physical commodity at a specified price. If the exchange can't enforce that obligation, the contract becomes meaningless. And if silver futures become meaningless, price discovery moves somewhere else, Shanghai, which means the center of gravity in global silver pricing, and by extension, precious metals pricing broadly, shifts from Western exchanges to Chinese markets. This isn't hypothetical, it's already happening. The Shanghai premium exists because Chinese buyers don't trust Western paper markets to deliver physical metal. They're willing to pay $20 more per ounce because they've already priced in the risk that COMEX is a fiction. And if that perception spreads, if institutional buyers in Europe, the Middle East, or sovereign wealth funds globally begin demanding physical delivery instead of rolling paper contracts, the squeeze accelerates, not gradually, violently, because the system has no buffer, no slack, no flexibility. It's been optimized for efficiency, and efficiency under pressure becomes brittleness. Here's the second order effect. Silver isn't just a commodity, it's a monetary hedge. When fiat currencies lose credibility, through inflation, through devaluation, through institutional failures, capital flows into hard assets, gold, silver, real estate, commodities. But gold is expensive, silver is accessible, and right now, silver is scarce. If prices continue climbing, $110, $120, $150, the narrative shifts from industrial commodity squeeze to currency collapse hedge. And that narrative pulls in a different class of buyer. Not traders, not funds, central banks, sovereign entities, national reserve managers. The same institutions that have spent 50 years accumulating dollars and treasury bonds suddenly begin diversifying into metals because the dollar, the euro, the yen, all of it, is losing credibility as a store of value. And when central banks compete for physical silver in size, the game changes entirely because they don't care about price, they care about possession. That's the endgame scenario, not a market correction, a power transition. From Western financial dominance to Eastern commodity sovereignty, from paper claims to physical control, from price as information to price as weapon. If you found this analysis useful, consider liking this video and subscribing to the channel, not for predictions, but for structural clarity in unstable markets. Now, let's ground this. Silver at $103 doesn't mean the system collapses tomorrow. It means the probability of structural failure has increased. The implosion risk is real, but it's conditional. It depends on whether delivery requests continue accelerating, whether COMEX inventory can absorb demand, whether institutional shorts can exit positions without triggering cascading liquidations, whether geopolitical tensions escalate further, driving more physical demand. History doesn't repeat events, it repeats incentives, and the incentives today look disturbingly similar to past inflection points. In 1971, the gold dollar peg broke because foreign governments demanded physical gold the US couldn't deliver. The system didn't collapse because of speculation. It collapsed because the promise exceeded the capacity. In 2008, Lehman Brothers didn't fail because of bad bets. It failed because the plumbing, the repo markets, the overnight lending, the collateral chains seized up. Prices were the headline. Plumbing was the story. And today, the plumbing in silver markets is showing stress. Arbitrage gaps that shouldn't exist. Delivery delays that shouldn't happen. Inventory draws that shouldn't persist. None of this means you should panic, but it means you should pay attention, because markets don't warn you before they break. They give you signals. Quiet, inconvenient signals that most people ignore because prices still look stable. The Shanghai premium is a signal. The COMEX inventory decline is a signal. The short squeeze dynamics are a signal. And the broader macroeconomic context, currency devaluation, geopolitical fracture, trade disruptions, amplifies all of them. You don't need to predict the future to prepare for structural risk. You just need to recognize when the system has less room to absorb shocks than it did before. And right now, the system has very little room, not because of malice, not because of conspiracy, because of decades of optimization that removed flexibility in exchange for efficiency. The brutal reality is this: efficient systems are profitable until they're not. And when they stop being profitable, they don't correct gradually. They snap. The risk of a brutal pullback is highest when everyone assumes the structure is sound. Right now, most market participants still assume silver futures will function normally, that COMEX will continue delivering, that arbitrage will eventually close the Shanghai gap, that the shorts will cover without triggering systemic dislocation. Maybe they're right, but if they're wrong, the consequences won't be contained to silver markets, because silver isn't isolated. It's connected to gold, to copper, to broader commodity indices, to inflation expectations, to currency valuations, to sovereign debt markets. When one piece of the plumbing fails, pressure redistributes. And sometimes that pressure finds the next weakest point. That's not prediction, that's systems thinking. So here's what you take away from this. First, prices are the headline. Plumbing is the story. When you see a price move, silver, stocks, bonds, whatever, ask yourself, what's happening underneath? Is liquidity increasing or decreasing? Are delivery mechanisms functioning or failing? Are arbitrage gaps widening or closing? Is the system absorbing stress or transmitting it? That's where the real risk lives. Second, history doesn't repeat events. It repeats incentives. The specific details change. The structure doesn't. When systems become rigid, they break under pressure. So when leverage becomes excessive, it unwinds violently. When promises exceed capacity, defaults follow. You've seen this cycle before. 1971, 1972, 1973, and you're seeing it again now, in a different market with different actors, but the same underlying mechanics. The silver fracture isn't about silver, it's about what happens when paper claims collide with physical reality. And in that collision, someone always loses. The question isn't whether the system can absorb this shock. The question is, how much more shock can it absorb before the structure cannot hold? I don't know the answer, neither does anyone else, but I know what the signals look like. And I know what happens when people ignore them. If this helped you see the system more clearly, consider liking this video and subscribing to the channel. Not for predictions, but for perspective. Because in unstable markets, perspective is the only edge that matters.